I welcome you all on behalf of Art University. Today we will start with continue with that chapter that is about investing in stocks, part B. It's your week number 5 presentation. I will be quick in this presentation because I have to convert this presentation to the video, and for video you need to compress the file. So we will move in this slides fastly, right? Buying stocks on margin. On margin, what is margin call? Margin call is a request from brokerage firm for investor to increase the cash in account in order to bring the margin back up to the minimum level. What is margin call? It is a call from brokerage firm if investor has done investment in, for example, multinational company and through brokerage firm J Security. So J Security person will call the investor that you need to increase your cash if it's below than 50% of the margin of investment you are doing. For example, if you do 1 lakh investment, you have 50% in backup, no 50,000 rupees in backup, and if the margin is less than 50,000, 45,000 or 48,000, the broker will call you to increase that to 50,000 so that you can go for investment of 1 lakh rupees. So this margin call is given to the investor, to the shareholder, when your investment rate is 50% of higher than the backup money kept with the broker, right? In on margin, purchasing a stock with a portion of funds borrowed from a brokerage firm like US Federal Reserve of United States do they limit margins up to 50%. Like if you're doing for 5 lakh rupees investment, at least 250 lakh should at least 2000 at least 2.5 lakh should be with minimum level in brokerage firm margin should be there. If it's not 2.5 lakh, then they will not go for 5 lakh investment on behalf of you. Broker will not go for that investment. So if it's less than 2.5 lakh, it's like 2.1 lakh, 2.2 lakh, the broker will call you to decrease that margin up to 2.5 or more than that and go for that 5 lakh rupees investment, right? So this is margin call, and 50% is the ratio on margin call, capping investment of doing investment more than 50% of the backup money is the broker, right? So 50% should be remembered when you go for margin call investment. What is the impact of this margin call? Here we have an example in which you are buying 100 shares of Lindy stock, which would require 50 per share or $5,000. You purchase 100 share margin by paying 2,000 in cash and borrowing 2,000 from brokerage firm. At this rate, if you are giving 3,000 cash and 2,000 from the brokerage firm at an interest of 12%, 1 year your stock can be sold for 60 per share, which is 50 per share today, and you can get 6,000 and repay the brokerage firm from the amount borrowed plus interest. Land stock pay dividend of 1 per share or $100 over a year. How it is did? Let's just have a look at this example. What it's saying, numerical is saying that you are buying a share 50 per share and you are buying 100 share of Lindy stock, which cost you $5,000. You have $3,000 in hand, but you are borrowing 2,000 from brokerage firm who is doing investment on behalf of you with that Lindy stock at annual interest of 12%. And after 1 year, when you sold those 50 per share price, $50 per share price, share of 5,000 to $6,000 at $6,000, you get repay the loan amount borrowed from the brokerage firm, which was 2,000 rupees at interest of 12%, and you pay dividend of 1 per share to the $100 over a year. So this 1 per share will be calculated on base of this numerical on margin call base, and you see how we. This is a formula. Return for buying a stock on margin, return is equal to S plus D minus I minus LP divided by I. S is proceeds from selling, D is dividend received over the investment period. I initial cash investment, LP is amount paid to broker on repayment of loan. You borrow $2,000 at your loan payment and loan payment from the broker firm. Loan payment is equal to $2,000, which was the borrowed amount from the broker, multiplied by 1 plus 0.12. 1 is 1 year you are using, and 0.12 is 0.12 is here the interest rate, like 12% annual interest. 12 divided by 100 will give 2.12, and 1 is the year, so 1 plus 0.12 is equal to $2,240. It means you will repay this amount of 240 to the broker from whom you borrow $2,000. So you're giving $240 additionally after 1 year of using that money, and remaining profit amount will go in your pocket. How? See here, The return on your investment is S plus D minus I minus LP divided by 1. 6,000 was your one after 1 year the price of share, like what you bought 5,000. 2,000 was borrowed from the broker and you paid 22,240 to them, uh, payback, plus $100 was the total dollar dividend you are paying here. D minus 3,000 is the amount you paid when you were buying the 5,000 rupees dollar $5,000 shares. Minus 2240 was the repayment of loan payment to the that broker for which you bought, divided by 3,000 of the in your investment. It gives you 0.2867 or 28.67%. So return is equal to S plus D minus I divided by 6,000 plus 100 minus 5,000 divided by 5,000. It gives you 22%. So 28.86% was your return, and return to the loan was 20. Second, we have example. Suppose the ND declined 40 per share dollar instead of increasing to 60 per share by end of the year. So you receive 4,000 when you sell the stock. Your return could not be higher. So what was the return in that case when your Lindy stock declined to get $40 per share instead of increasing to $60? Like in first case, your dollar price of the stocks increasing $10 per share from 50 to $60 per hour. And now in the second case, if it get down to 40, what how you will you pay that money to that loan payment of that broker? Look at the example here, solution here. Return is equal to S plus D minus I is for investment, LP is for loan payment, I is for your investment, and D is dividend, and S is your overall income after 1 year. It's give you 4,000 plus 100 minus 3,000 minus 240 divided by 3,000, you get minus 38%. Using all cash, your return would be 4,000 plus 100 minus 5,000 divided by 5,000, you get minus 18. So 18% loss you are doing on that investment if the prices of that of the decrease from $50 to $40 per share. So you can get minus 38% your return loss, and minus 18% loss will be given to that loan payment which you have bought from the brokerage. SM performance stock comparing returns to an index, a convenient method of measuring performance. Price quotation for index used to measure stock performance and are reported financial newspaper. So we assess performance of investment of stocks by comparing that to different methods here. So assessing performance of stock investment, here we have quarter 1, 2, 3, 4 stock performance evolution, return on their companies here, return on staffing stocks, return on US stock index, and excess return staffing stock above the market. You are getting in the Stephanie stock minus 1% and US stock 3%. So overall you are getting minus 4% of the excess return. Then you are getting 2% in second quarter by return on Stephanie and 3% on US stock. You are getting again minus 1%. 5%, 7%, and minus 2%, 6%, 9%, minus 3%. And you must be thinking, sir, why it's going negative and positive? Negative is 3% you are getting a US return, but US return and minus 1 on Stephanie stock return. So it was above the market, so it give you 4%. Why? Because 3% was that return and minus 1 was Stephanie loss, but overall US market was good than Stephen in first quarter, so you get minus 4%. In second, 2% positive, 3% positive, minus 1% negative. Why? Because 1% in first quarter which you lose here, which you added here, is reduced. So you are still in negative minus 1%. Then 5% profit and 7% return on that, you get minus 2%. Why? Because these are positive, but these are going negative sometimes, and these are minus from that. 3 minus 1, minus 3 minus 1, minus 3 minus 1, you get minus 4. 3 minus 2, you get minus 1. 7 minus 2, you are subtracting this from this. Minus 1, minus 3, minus 4. Minus 2, minus 3, you get minus 1. Minus 2 plus 3, you get minus 1. And then 5 minus 7, you get minus 2. 6 minus 9, you get minus 3. Like from smaller, these are minus. Minus 1, minus 3, minus 4. 2 minus 3, you get minus 1. 5 minus 7, you get minus 2. And 6 minus 9, you get minus 3. These are stock performance comparison in which you can do assessment on the basis of watching those stocks return. Here are details of those stocks. This financial planning online can also be done by watching stock summary through the going website bloomberg.com. Click on markets, and website provide a summary of recent stock performance in international market. Then the other site for financial planning, stock and quotations, finance.yahoo, http finance.yahoo.com/m1 question mark U. This website provides recent quotation of index that can be used as benchmarks when assessing your investment portfolio performance. Click on charts to review historical movements in any specific. Key decision about investing in common stock for your financial plans are: should you consider buying stock? Which stock should be you purchase? What method should you use for investing stock? How stock investment fits within your financial plan is for this, that how stock investment fits in your financial package, financial budget, financial plan. You should consider buying stock, which stocks to buy, which stocks to sell, and which method to use for investing stock.